I said he's a Bhishmacharya of valuation, and उनका उत्साह देख के I got further energized because I was quite enthusiastic in valuation and I was feeling that कि valuation ठंडा हो जाएगा. But जब मैं हरीश जी को मिला, तो I was further inspired more and more. So I am sure that on my request, she immediately agreed to join as a panel speaker. And I like his one quality that he keeps on guiding the youngsters based on his huge knowledge. The second panelist, I think, is not new to me because we have been friends for many years. And though I should not say directly, but I have been his dedicated and deep also for many years. Normally, your vote should be secret, but Amit's vote was always open for me. He was the immediate past president of CMA. So we are proud to have Amit Ji, the president of the institute. Has been the panel speaker here. I mean, that is the advantage of, or I am taking the disadvantage of my friendship with him by encroaching on his time because he handles ERP, he handles few KPOs, and apart from the lot of responsibilities he has of the institute, he still spares the time, which will clearly tell you that I am taking disadvantages from my last 10 years leadership and all the 10 years votes I gave it.
आनंद जी, सर की आवाज क्लियर है आपको? Sir, your voice is little blurred. I am not talking to me or to everyone.
1 minute.
विंड का आवाज आ रहा है ऐसा लग रहा है.
अभी नहीं आएगा. Can you hear me now? Okay. So, as far as Sudha G is concerned, I think we have been with each other on many joint ventures. And one day I came to know that she has written 6 books. Uske baad mein, and then we had a program in Bombay Stock Exchange. And the amount of audience which came there, I said that now at least I should get inspired to read something about cross-country transactions, for which I have zero knowledge, honestly. So, Sudha Ji, who has written 6 books, and many of us even are scared of writing one article even, leave aside a book. Okay, so kudos to you and hats off to you for joining this panel and agreeing to share your great special knowledge on cross-border, etc. And then last I come to Anand. I mean, this sequence is only on account of age because we had no way to sequence it. So we finally asked age to everybody and decided this sequence. आजकल के जमाने में age is such a irrelevant factor that I have found one 65 plus guy easily beating physically to a 35 age guy. And I have also seen a 35 age guy beating in knowledge to a 65 years guy. So age is just a number. But Anand ji ne jo number of...
And firstly, wishing everyone a very, very happy Independence Day to all the participants. It has been a very good session till now. We have discussed about the lot of valuation issues. Now, one of the very different valuation is cross-border valuation. When we talk about the cross-border valuation, now what exactly differentiates the cross-border valuation from domestic valuation? What is the difference when we talk about a valuation which is done in India itself and when evaluation which is done from India to an Australian company or from US to Africa or from US to India? What exactly is changing there? As far as so the difference is exactly what exactly differentiates the cross-border valuation from the domestic valuation is the same difference as is the difference between cross-border transactions and domestic transactions. So the difference is of the risk that is there in between the cross-border transaction. For example, the foreign exchange fluctuation risk, which is absolutely not there when there is a valuation that we need to do when we are doing a transaction within India. So foreign exchange evaluation of acquisition of a company or in an investment in a company or a merger that is happening in India, that will not face the risk of foreign exchange. So when we are doing that valuation, we don't need to factor that in. Another thing that differentiates the cross-border valuation from the domestic valuation is country risk. Now, country risk, country risk is something which is privy to the economy of the country, to the political situation of the country, to the regulatory framework of the country, and it includes the political and economic risk of the country itself. So we can take it as, for example, a recession in a country that reduces the revenue of exporters to that nation is a realization of a country risk. Another risk what we can quantify as a country risk is labor strike by country workers, tractors, or the strike that may happen. Also, there may be clashes between the rival ethnic or religious groups. So there may be a lot of country risk that is faced when there is a transaction, inter-country transaction. Regulatory framework, we're going to discuss that in detail. Political risk, very big risk always in a cross-border transactions, cross-border, for example, the investments from China right now. So those investments have been, all of a sudden, the Indian government came up with a circular press note by that all the investments that are made from the countries that shares the land border with India will come under approval route now. Now, what happens to the companies in India? And that was especially, it came for China, that whatever investment will, from the date of issue of that press note, whatever investment comes in India will be coming under the approval route only. Now, what happens to those transactions which were already under the stages of execution? What happens to those right issue to the shareholders of the company which is in China? So all this political risk and regulatory risk always is there when there are investment, when there are cross-border transactions. Therefore, whenever we are doing the cross-border valuation, one has to take into consideration these type of risks that are there in the cross-border transaction. So why one goes into the cross-border transaction, the investment in foreign territories are there, because it brings its own advantages as well. So the advantages can be strategic. It may be for the strategic reasons that the investment is made. It may be for the asset acquisition in the foreign country that the investment is made. It may be for the financial reason. So strategic reason may be that there is like India and China, we have very attractive raw material and labor costs. It may be for the reason of accelerating growth, leveraging on intangible asset base. It may be to acquire the assets in the form of technology and capability. One of the most important reason, one of the most prevalent reason of the cross-border transactions or merger and acquisitions cross-border is diversification in the new markets. Also, the reduction in cost of capital, or maybe the reason may be as far as the tax structuring can also be one of the reasons. One of the most important consideration, when it comes to looking into the cross-border transaction is the regulatory framework of the country, in which country the investment is being made. So, not going too much far away, let us understand that when there is a cross-border investment that is happening, so investment will happen, that's why the valuation will come. So, we need to understand the regulatory framework regarding around it. So, when there is an investment is happening in India or from outside India, the valuation that is prescribed under FEMA. So when an entity from USA wants to invest in India, or an entity from India wants to invest outside India, in that case it has to comply with the Indian regulatory framework. So that is very, very privy to the international transaction only. For example, that when there is an investment from India to Australia, so one has to comply with the regulatory framework of that country as well. So as far as India is concerned, the cross-border transactions, as we all know, is regulated by FEMA, and FEMA gives the pricing guidelines which needs to be complied with. There are pricing guidelines which needs to be complied with whenever there is a valuation at what value the transaction will happen. Under FEMA is prescribed in the pricing guidelines given under NDI rules. These pricing guidelines on valuation, that at what value the transaction will happen. So these are guidelines. It doesn't say the specific value, but it gives the cap. It gives the floor price and it gives the cap price between which the transaction can happen. So these pricing guidelines have seen a lot of evolution over a period of time. It started with CCI guidelines, then it went somewhere in 2010. They made it compulsory that whatever investment is happening from India or in India, whenever there is a transfer of equity shares or convertible instruments from India, it will be calculated using discounted cash flow method only. Progressively, in 2014, however, there was a circular dated July 15, under which they allowed that any valuation, whenever there is an equity shares, equity instruments, I will use the word equity instrument because it constitutes equity shares, CCPS, CCRDs. So whenever there is an investment from Indian party to an outside investor, to a foreign investor, it shall be done. The valuation can be done by using the internationally accepted pricing methodology and vice versa. So whenever there is an investment, the Indian resident is transferring shares to outsider, or a foreign investor is transferring shares to an Indian resident. The pricing guideline says that it has to be at the internationally accepted pricing methodology only. So what exactly is CCI guidelines? Under CCI guidelines, it was that it prescribed the method that either NAV can be used, market value method could be used, or profit earning capacity method. It was based on the historical data, except market value, which should only be used for listed company. It was based on the CCI guidelines, were based on the historical data, and it set the floor price at which the share could be transferred. We all know, so this was changed to DCF. We all know that DCF is a forward-looking exercise, and in fact, even now we use DCF only. However, the option has been now given to use the internationally accepted methodology. So, as it stands right now, the pricing guidelines, as it stands right now, is that in case of a listed company, the pricing is as worked out by using, in case there is an issue by an Indian company or transferred from resident to non-resident, price should not be less than the price worked out in accordance with the relevant SEBI guidelines. And in case of unlisted company, the price. So if there is, as I said, there is a floor price and there is a cap price. How is it determined? It is determined that if the transfer is happening from resident to non-resident, if the transfer of equity instruments is happening from resident to non-resident, in that case the price has to be more than the fair value which is worked out by following the internationally accepted pricing methodology. So we all know that internationally accepted pricing methodology also it is three type of valuation methodologies are there, and basis as Amitji very aptly distinguished between manufacturing and software company. So basis the sector, basis the various other parameters, it can be decided that which method is the best method. Now, however, if the transfer is from non-resident to resident, that means the money is going out. So if the money is going out, the pricing at which it can go out is capped. So it cannot be more than the fair value as per internationally accepted methodology. So there is a cap that is there as far as the pricing guidelines are concerned. Few of the other things which are relevant from the perspective of valuation, in international transactions, whenever there is a merger, acquisition happening, cross-border merger happening or acquisition happening of the equity instrument or the stake in the equity. So another important thing is that if the company is going through the delisting process, then the pricing, so these are the general pricing guidelines and these are the specific pricing guidelines that we are seeing here. That if the company is going through the delisting process, then in that case, the valuation is to be arrived at by using the methodology that has been specified under the SEBI delisting of equity shares regulation 2019. In case of swap of equity instrument, that means the equity instruments of the foreign entity is getting swapped with the Indian entity. In that case, the valuation is required to be obtained from the registered merchant banker. Let me clarify it here that in international transactions in India, till now the valuation is not made compulsory to by the registered valuer. It can still be taken from the cost accountant, merchant banker or chartered accountant as specified. Now, if the shares are to be valued, which are taken by way of subscription to memorandum of association, the shares can be valued at the face value and it is not required to be fair valued. Share warrant, the pricing formula and the conversion formula is required to be determined upfront. Also, in case of CCPS and CCDs, the issue price and formula to be specified upfront at the time of issue. What does it mean? It means that price at the rate of conversion date shall be not less than the FMV at the issue date. So let us see it with an example. What do I mean? So CCPS and CCDs, it is compulsorily convertible debenture and compulsorily convertible equity shares. Preference shares. So what we are seeing here is that X Limited, a company in India, it issued CCD to Y Limited, a company in USA. It was issued in June 2019 and the fair value was INR 2000 at the date of issuance. The conversion is due in May 2020. Due to COVID-19 situation, the fair value in May 2020 is INR 100 only at the time of conversion. Now, although if you see what we saw that in the pricing guidelines, the pricing of the shares cannot be less than the fair value at the time of issuance of the convertible instrument. So even though the value right now, as in May 2020, although the value is 100, however, the conversion that cannot happen at the price which is less than 200. So the floor price is fixed at 200 because at the time of issuance of the convertible debentures, the price was 200. So the investor will have to accept the shares at the higher fair value. value being 200, not, and it cannot be issued at the the shares cannot be issued at the price of INR 100. So this is the particular cases regarding how the valuation as such is regulated in terms of international acquisitions and transfers in India. Although there is another one thing, that is deferred consideration, that how the payment of valuation consideration can come, although not very relevant to the valuation, but it is relevant to be discussed here because it is relevant for it talks about the valuation consideration. So if there is a valuation consideration that has to flow from outside India to India, it cannot be deferred for more than 18 months from the date of transfer agreement, and not more than 25% of the total consideration can be deferred, and it can be settled through the escrow account or indemnity. So this is the whole of the framework of this is the whole of the regulatory framework as far as the India is concerned when it comes to the valuations of international transactions. I'm using the term international transaction a bit loosely here so that it makes sense. Otherwise, I should be using the term equity instruments. Another regulatory thing that is relevant as far as India is concerned and the valuation is concerned is that cross-border valuation. So cross-border valuation, what exactly initially cross-border valuations was allowed only where the cross-border mergers were allowed only where the merger was wherein the foreign company merged into an Indian company. So that only was allowed. However, there was a shift in the regulation, and wide notification number 389/2018, FEMA notification 389/2018, it was made available that the Indian company can be merged into foreign company as well. So the cross-border merger, now both ways the cross-border mergers are now allowed. It may be the cross-border, whether the Indian company is allowed to be merged into the foreign company, and also the foreign company is also allowed to be merged into Indian company. So this is the whole regulatory framework as far as India is concerned. Now, apart from let us now come to the pure valuation per se. What are special considerations that are required to be given in the cross-border valuation? Now, apart from few considerations, the method of domestic valuation or international transaction valuations remain same. It is not that in domestic valuation you are using DCF or market value or asset-based method, and in international when you are doing cross-border valuation, you are using another type of valuation methodology. No, the methodology that is there in the domestic valuation remains same when we are doing the cross-border valuation. So we can say that valuation doesn't change. So valuation, as we define valuation, it is about the value that is seen by the buyer, and so we say that the beauty lies in the eyes of beholder. Similarly, the value lies in the eyes of buyer. So apart from few adjustments that are specific to cross-border valuation, all the adjustments remains the same. Like you will add control premium for acquisition of majority stake, or will discount the valuation for lack of marketability. So everything remains the same in cross-border valuation as well. However, these are the different valuation considerations that are required to be taken when it comes to the cross-border valuation. That is choice of currency, earned and remitted income, tax rates, cost of capital, very relevant, and treatment of country risk. Now let us see what are these different adjustments or different considerations that are required, particularly in case of cross-border valuations. So what can be the various cases of cross-border valuation? There can be enormous cases wherein the cross-border valuation is required to be done. However, few of them may be that when an Indian entity is acquiring shares in a company outside India, when a company outside India is acquiring shares in India, when an Indian company is merging into parent company, or when the company outside India is merging into an Indian company. So how does a firm in one country evaluate an investment in a, or how does it evaluate a foreign project that the firm is itself is undertaking? Both the questions are very important, and it has gained more relevance in the present scenario. As far as the domestic valuation is concerned, we know that these questions require that the firm estimate the future free cash flows to equity of investment and discount this cash flow at the some appropriate discounting rate. So basically, in the most used method, as we know, is the DCF method that we use. In any case, in the cross-border valuation, it will be very difficult to find a transaction or a company which has the same which can be taken as a comparable company for the valuation or comparable transaction. So we in cross-border valuation mostly, in cross-border valuation also, we are using mostly the DCF. When we are doing DCF, we know that the most important question that needs consideration is the estimation of future free cash flows to equity of the investment and the determination of cash flow, and then discounting this cash flow at some appropriate discounting rate. And that appropriate discounting rate is the cost of capital. In the cost of capital, the discounting rate, it reflects the investment of investments, the cost of equity financing. In domestic valuation, if you see, we use capital asset pricing model, which allows a systematic comparison of the cost of equity of various unit firms. The classic CAPM, it recognizes that the systematic risk cannot be eroded, cannot be taken away. However, the unsystematic risk can be eroded. So the discount rate of equity finance project is based on this beta times the equity market premium, or the excess return of the broad equity market portfolio over the risk-free rate. Now, when we see the same thing in the international setting, it is not known that which country equity market premium should be used in the evaluation. That is of the acquiring firm or that of the target firm. If there is an investment from India to Australia or from US to Africa, if there is an investment from US to Africa, whether the cost of capital that is to be taken is of the investee, that is the African entity, or it is for the investor, that is US entity. Similarly, if there is an investment from India to Australia, whether the investment is the cost of capital will be for the Australia or Australian with regard to Australia, or it will be with regard to India. That is, and also if we see in the international valuations, the matter is more complicated because there are more dimensions of risk for which financial market participants require a premium. So the focal point, the main point of discussion is that the method by which various dimensions of risk, whatever risk is there, it can be incorporated in the cost of capital. So cost of capital, determination of cost of capital is one of the most, determination of the correct cost of capital is one of the most important parameter that needs to be decided on. This is However, it is not very easy to come at it, and there are various methods that are used and to decide the appropriate cost of capital. It depends on whether the market are fully integrated or it is not integrated. It depends on lot of factors like that needs to be taken into consideration. One thing, so cost of capital in practically, if you ask me, cost of capital usually will come from, if you are valuing a company, so it will come from them only. It should come from them. The cost of capital will come from the will come from the party only, and it will be because it's one of the. So going ahead, that there are two methods basically in which the valuation as the cross-border valuations can be undertaken. So these methods is that we know that if we are taking if Indian company is making an investment in Australia and the determination is required to be done for the valuation of the Australian company, there are two methods in which it can be done. One method is that so as I said, the valuation method doesn't change. There are only considerations that one needs to take into consideration. So analyzing, first important thing is to analyze the historical performance, and after that forecasting the foreign cash flows, adjusting it to incorporate foreign currency inflation rate, using the appropriate marginal tax rate, and including the terminal value. Now there are two methods through which it can be done. That the first method is that perform the valuation in Australia, the valuation in Australian currency, discount the projected cash flow with the discount rate denominated in Australian dollar, and convert the resulting value into the Indian currency. So it can be that you are forecasting the cash flows in the investee country currency. Discount rate is also of the investee country currency. What does that mean? That while coming at the discount rate, the factors that are taken into consideration are developed using input denominated in that investee country only. The second method that can be used when cross-border valuations is done is to convert cash flow at a forecasted exchange rate into the investor currency. That initially only you are converting the cash flow into the investor country currency, and then the discount rate that is being used is the discount rate of investor country discount rate, and it is forecasted. The forecasted rate is already, in this case there is obviously it is forecasted in the forecasted exchange rate. It includes the risk associated with the exchange rate fluctuations already. So the PV that comes is in the home currency only. So this is where the common error happens, the mismatching of the cost of capital and the currency of projection. So the currency of projection should always be consistent with the currency of discount rate. I think this is the whole of the crust when we talk about the cross-border valuation, that the currency of projection should always be consistent with the currency of discount rate, which means that the inputs used to derive a discount rate should be in the same currency used to project the cash flows. So if the cash flows are denominated in Australian dollar, then the risk-free rate, equity premium or other discount rate input should also be denominated in the Canadian dollar term, or in the Australian dollar terms only. So this choice of currency, whether you want the currency to be Indian currency, Australian currency, Canadian currency, home currency or foreign currency. So the home currency is the currency in which the investor is there. Foreign currency is the currency in which the investee company is there. So the choice can be that it can be done in both the currencies, And foreign currency cash flows should be discounted at the foreign currency discount rate that we have already seen, and discounted the home currency cash flows should be discounted at the home currency discount rate only. So so what we are seeing here is various adjustments that are required to be made in case of cross-border valuation. One of important thing also is the earned versus remitted income. So when the US entity invest in Africa, it has to see the cash flows that it is earning into Africa, and not the cash flows which is actually remitted back to the parent company. If it is seen the cash that is remitted back, it may be relevant for the structuring purposes, for the tax structuring, for analyzing from which jurisdiction to make investment. However, as far as the valuation is concerned, the earned versus remitted income, it does not make much of the difference. Taxes, different countries have different type of taxes. There are different tax rates. So, and the requirement of time and timing of tax payments are different. So these all should be kept in consideration. So we can see from the example that in India we have this MAT. In some countries we have losses carried back also. So all these particular taxes that are there and that are specific to the countries, that should be kept in consideration while doing the cross-border valuation. One of the other important is the country risk. The country risk needs to be adjusted. So the particular country risk, it needs to be adjusted while calculating the cost of capital. It can be, or it can be done in two ways. One is that the country risk is directly reflected in projected cash flows and probably assessment of each scenario, or it can be reflected in the cost of equity and debt capital. So depending the judgment whether the country risk is systematic or unsystematic, it can be it needs to be adjusted. So if it is unsystematic, obviously it needs to be ignored, and if it is systematic, in that case it may be taken into consideration while calculating. It may be reflected in cash flow, or it may be taken into consideration by adding it to the cost of capital. So that is all. There are that's the different valuation considerations that we have seen, and that is all regarding the cross-border valuation. If you have any queries, you can kindly ask. So
Great, Sudha Ji. I think I am sure you already are an international brand, and when you will be interviewed by New York Times or Times of London, that time we are going to show on our YouTube channel कि Sudha Ji had given the lecture at our place and now she has gone to New York Times. So very well done, and then obviously an excellent sharing lecture, and in a very short time that too. I know that she has shortage of time, but well, I think the crispness is very important. Now we go to Anand Ji, and Anand Gaude sir, I was very keen to listen to him sometime because